Okay, let's unpack this. Today, we're diving deep into a monumental piece of legislation, H.R. 1. Some folks have informally called it the One Big Beautiful Bill.
Uh-huh.
This thing, it passed by a really narrow vote, 218-214, in the House on July 3rd, 2025. And President Trump signed it just yesterday, July 4th. Its scope is, well, it's extraordinary.
It really is. It's structured as a budget reconciliation package.
Right, which means it could pass the Senate with just a simple majority, kind of bypasses the usual filibuster hurdles.
Exactly. And at 870 pages, it's going to touch pretty much every industry, every household in the country.
Think of it like a blueprint, maybe. A blueprint for some really significant shifts.
What's fascinating, truly, is just the sheer breadth of it and the ambition. This isn't just, a tax bill or just healthcare or energy. It pulls together priorities from 10 different Senate committees. That makes it one of the most consequential laws we've seen in quite a while.
So our mission today, really, is to cut through all that complexity.
Yeah, cut through the noise, help you grab the most important nuggets from this huge bill, and really try to connect the dots. How might these changes actually affect you, your family, maybe your business?
Okay, let's start with what's probably closest to home for most people, your wallet. This bill makes some big moves on individual and family taxes. A lot of the 2017 Tax Cuts and Jobs Act stuff is becoming permanent now, right? Plus some new benefits thrown in.
Indeed. The section title actually says, Make American Families and Workers Thrive Again. So it's a mix of extensions and some new relief. I think the core insight here for individuals is that permanence. Knowing that key tax cuts are locked in, that gives you more predictability for financial planning. You avoid those tax hikes that were looming.
Right, the so-called tax cliff.
Exactly.
Yeah.
So, for instance, those modified federal income tax rates and brackets from 2017, they're permanent now. Stability for your income tax. And that nearly doubled standard deduction, also permanent. For 2025, the base amounts are jumping up to about $15,750 for single filers, $31,500 for married filing jointly, and they'll adjust for inflation each year.
Okay, but didn't something get repealed?
Yes, the deduction for personal exemptions, that's permanently repealed. It's a shift from how taxes used to work.
So some deductions disappear, others get bigger. What about the child tax credit? That's always a big one for families.
Right. The $2,000 per child credit is made permanent. That includes those higher income phase-outs, so more families keep qualifying. The non-refundable part actually gets a little bump, up to $2,200 for 2025.
Okay.
But it keeps and even expands the requirement for work-eligible Social Security numbers for the child, the taxpayer, and the spouse on joint returns.
Got it. And for folks thinking about estate planning?
The increased exemption amounts for the estate and gift tax permanently extended. They jump up significantly, $15 million for single filers, $30 million for married filing jointly in 2026, and indexed for inflation after that.
Wow, so that means way fewer estates will actually pay federal estate taxes.
Precisely. A very small percentage, actually.
Okay, and for homeowners, what's the deal with the mortgage interest deduction?
That deduction for qualified residence interest, it's permanently lowered. It now only applies to the first $750,000 of home mortgage acquisition debt.
So if your mortgage is bigger than that?
A smaller slice of your interest will be deductible, yeah. And other itemized deductions, the miscellaneous ones, permanently gone. And there's a new rule for taxpayers in the highest income bracket, the 37% one. It caps the value of each dollar of their itemized deductions at 35 cents. So it effectively lowers the benefit they get from those deductions.
That sounds like a pretty big change for some higher earners. And the state and local tax deduction, SALTI, that's been controversial for a while. What's the final word there?
Well, the bill temporarily increases the cap on SALT deductions. For 2025, it's $20,000 if you're married filing separately, $40,000 for everyone else.
Okay, an increase, but temporary.
Temporary, it gets complicated. Those amounts start to phase down if your modified adjusted gross income or MAGI goes over certain levels. $250K is for married filing separately, $500 for others. And even weirder, these caps actually increase each year from 2026 through 2029.
They go up.
They go up, but then starting in 2030, the limit snaps back to the current $5,000 or $10,000 levels.
Okay, that's complex.
It is. And importantly, this bill doesn't block those state-level workarounds that let pass-through entities kind of get around the cap. Those are still okay.
Interesting. Okay, and for small business owners?
Yeah.
Is the qualified business income deduction, QBI, sticking around?
Yes, good news there for many. The 20% QBI deduction is permanent. There's a new minimum deduction, too, $400 if you have at least $1,000 of QBI. Just ensures even really small businesses get something.
Right.
Some other adjustments, deductions for bicycle commuting reimbursements, most moving expenses, those are permanently eliminated, though there are exceptions for active duty military and intelligence folks.
Okay.
And all gambling loss deductions. Permanently limited to however much you won, can't deduct more than your winnings.
Makes sense. So a lot of existing stuff made permanent or tweaked, but the bill also brings in some totally new tax relief. That's pretty interesting.
Yeah.
What are the highlights?
Absolutely. One really notable one, though, it's temporary. Just 2025 through 2028 is a new deduction for qualified tips. It's an above-the-line deduction, meaning you take it before calculating your adjusted gross income.
So no tax on tips, basically.
To a limit, yeah.
Ah.
If you're in a traditionally tipped job, you can deduct up to $25,000 of your tips each year. There are income phase-outs if you earn a lot, but for many workers, it effectively means no federal income tax on those tips.
Wow. No tax on tips. That's a headline grabber. Directly impacts take-home pay for millions.
It is. And the bill also expands the FICA tip tax credit for employers to cover beauty service places, too.
What else is new for workers?
Also new, also temporary for 2025 through 2028 is an above-the-line deduction for overtime pay. The premium part of it, that's limited to $12,500 a year or $25,000 if you're married, filing jointly. Same kind of income phase-outs as the tip deduction.
Okay.
And for both of these new deductions, tips and overtime, you need a work-eligible Social Security number.
Got it. Any other new deductions?
There's one for seniors. A temporary $4,000 deduction for people 65 or older. Again, 2025 through 2028 with income phase-outs.
What about car loans? That sounds like a unique deduction.
It is pretty unique. A new temporary deduction, 2025 to 2028 again, for interest paid on a qualified passenger vehicle loan, up to $10,000. Now, this one's taken after you calculate your adjusted gross income, AGI, and it phases out for higher incomes, too.
And there are rules about the car itself.
Yeah, has to be U.S. assembled. Original use has to start with you, the taxpayer, and it needs a gross vehicle weight under 14,000 pounds. The idea seems to be providing direct relief for car buyers, especially those supporting domestic manufacturing.
Makes sense. Anything else on the relief front?
Oh, yes. The employer-provided childcare credit gets a huge boost. It's made permanent, and the maximum credit jumps way up to $500,000, covering 40% of expenses. Small businesses get an even bigger max credit.
So a big incentive for companies to offer childcare help.
Definitely. And it allows small businesses to pool resources, use third parties, makes it more feasible. Also, the paid family and medical leave credit, permanently extended, expanded, lowers the minimum employee work requirement, makes it available everywhere.
Good for families. And adoption.
The adoption tax credit is made partially refundable, up to $5,000, indexed for inflation. That makes it more accessible, provides actual cash back for some families.
And for those saving for education, what's changing with 529 accounts?
Good news there, too. You can now use tax-exempt distributions from 529 plans for a wider range of K-12 and homeschool expenses, things like curriculum, tutoring, testing fees, and also for qualified post-secondary credentialing expenses, not just traditional degree.
Broadens the use quite a bit.
It does. And the bill also brings back and makes permanent that temporary deduction for non-itemizers who make charitable donations, up to $1,000 single, $2,000 married, filing jointly, for cash contributions, taken after AGI.
Okay, now one of the really innovative parts, maybe transformative, is the creation of these MAGA accounts. What are they?
Right. MAGA stands for Money Accounts for Growth and Advancement. They're a totally new kind of savings account. The idea is to incentivize education, entrepreneurship, and homeownership, starting really young.
How young?
Parents of kids under 8, including those born before 2024, can open them. Taxable entities, like maybe family members or businesses, can contribute up to $5,000 a year, indexed. But tax-exempt groups, they can put in unlimited amounts for qualified groups of kids.
Unlimited. Wow.
Yeah. Contributions stop at age 18. But here's the interesting part, the access rules. At age 18, the account holder can take out up to 50% of the funds for higher ed, training, a small business loan, or a first-time home purchase.
Okay, half at 18 for specific goals.
Right. Then at age 25, they can access the full balance for those same purposes. And at age 30, the full balance is available for any purpose. No restrictions.
And how are the distributions taxed?
Qualified distributions for those specific purposes are taxed as long-term capital gains, which is usually a lower rate. Others are taxed as ordinary income.
And there's a government contribution, too.
There's a pilot program, yes. The federal government will put $1,000 into eligible MAGA accounts for U.S. citizens born between 2024 and 2028. Treasury will even set up accounts if parents don't. It's really positioned as a long-term investment in the next generation's financial future.
That is definitely thinking long-term. Okay, beyond finances, this bill also digs into health. What are the key health provisions?
Under the investing in health part, it codifies and actually renames individual coverage HRAs. They're now called Custom Health Option and Individual Care Expense Arrangements. Choice arrangements.
Choice. Okay, what do they do?
They basically let employees use employer-provided HRA money to buy their own health insurance on the individual market. Gives people more, well, choice. And there's even a temporary tax credit for small businesses, under 50 employees, that offer these choice arrangements for the first time. $100 per employee per month in year one.
Help small businesses offer benefits. And what about health savings accounts, HSAs? They're pretty popular already.
Yeah, and this bill significantly expands HSA access and flexibility.
Yeah.
Big changes here. For one, people eligible for Medicare Part A can now contribute to an HSA if they're also enrolled in a high-deductible health plan. That's new.
That is new.
HSA funds can also now be used for direct primary care services up to certain monthly limits, and for physical fitness memberships or instruction up to $500 or $1,000 a year.
So you can use HSA money for gym memberships.
Up to the limit, yes. It broadens their use for general health and wellness, not just treating illness. Also, all bronze and catastrophic plans on the exchange are now automatically HSA eligible, and people using discounted on-site employee clinics can also have HSAs.
Wow, really opening up eligibility.
Definitely. And more flexibility, too. If both spouses are 55 or older, they can both make catch-up contributions to the same HSA account. Employers can let employees roll over unused money from flexible spending accounts, FSAs, or regular HRAs into an HSA when they switch to a high-deductible plan.
That helps avoid losing that money.
Exactly. And medical expenses you incur up to 60 days before you officially establish your HSA. Those are now eligible for reimbursement. Plus, you can have an HSA even if your spouse has an FSA, which wasn't always the case.
Lots of small tweaks adding up.
They do. And one more big one. There's an increased HSA contribution limit for lower and middle income folks. If you make under $75,000 individually or $150,000 as a family, you can contribute an extra $4,300 or $8,550 respectively each year. It phases out for higher incomes.
So a clear push to get more people using HSAs, especially those with lower incomes.
That seems to be the goal, yes. Expand access, expand utility.
Okay, after navigating personal finances and health, let's pivot. How does this bill aim to reshape the broader economy? It seems to zero in on boosting local economies, right?
Yeah.
Especially rural America and Main Street.
That's the focus of Subtitle B, yeah. Fostering growth by supporting businesses, small manufacturers, opportunity zone investors, rural healthcare providers. It starts by extending some key business tax cuts from the 2017 law. A huge one. Businesses can now permanently and immediately expense 100% of the cost of qualified property. That's bonus depreciation.
So instead of deducting costs over years, they write it all off up front.
Exactly. A massive immediate tax incentive to invest in new equipment, machinery, things like that.
Okay, and what about research and development? R&D is crucial for innovation.
Yes, another big change. Taxpayers can now permanently and immediately deduct domestic R&D research and experimental expenditures. Previously, you had to amortize those costs over 5 years. Now, it's an immediate deduction.
And that's retroactive for small businesses.
For small businesses, yes. They can apply this change back to expenses incurred after December 31st, 2021. That could mean significant refunds or lower tax bills now.
Wow. Okay, what else for businesses?
The cap on deducting business interest expense, Section 163J, will permanently use an EBITDA calculation for adjusted taxable income.
EBITDA, earnings before interest, taxes, depreciation, amortization.
Right. Generally, using EBITDA allows businesses to deduct more interest expense compared to the previous calculation based on EBIT. Also, a technical change. The definition of motor vehicle for floor plan financing interest is permanently tweaked to include certain trailers and campers. Helps those dealers.
The bill also tackles international tax rules, which can get pretty complex.
They can. It makes some significant reforms there. To simplify, it renames things like GILTI and FDII.
GILTI being Global Intangible Low-Taxed Income.
Right. Now it's Net CFC Tested Income. And FDII, Foreign Derived Intangible Income, is now Foreign Derived Deduction Eligible Income. The key thing is they both get a new effective tax rate of 14% after 2025.
So simplifying and potentially lowering the tax on certain foreign earnings for U.S. companies.
That seems to be the aim, making U.S. multinationals more competitive globally. The base erosion anti-abuse tax, or BEAT, rate is permanently set at 10.5%, and companies get more flexibility in using certain tax credits against it.
Okay. Shifting to new tax relief for businesses, what's this about qualified production property?
This is interesting. It lets taxpayers immediately deduct 100% of the cost of certain new factories, improvements to existing ones, and other structures used in specific production activities.
Another powerful incentive for domestic manufacturing.
Very powerful, though the definition of production here is limited to agricultural and chemical manufacturing specifically.
Oh, okay. Not all manufacturing.
Not all, but still significant for those sectors. The bill also creates a second round of opportunity zones.
More OZs? When?
They'll run from January 1, 2027 through December 31st, 2033. But the definition of a qualifier low-income community is tightened up a bit. And there's a big focus on rural areas. At least a third of the newly designated zones must be rural.
And there's a special type of fund for them.
Yes, new Rural Qualified Opportunity Funds, RQOFs. Investments in these, held for at least 5 years, get a bigger tax benefit, a 30% step up in basis compared to 10% for regular QOFs.
A strong carrot for investing in rural communities.
Definitely. And taxpayers can also invest up to $10,000 of post-tax ordinary income into either type of OZ fund now.
That's a clear push for development outside the big cities. What about general expensing for business assets, like under Section 179?
That gets a boost too. The maximum amount a business can expense under Section 179 is increased to $2.5 million. The phase-out threshold, where the benefit starts to decrease, goes up to $4 million in property costs.
So small and medium businesses can write off more equipment costs immediately.
Exactly. Big help for cash flow and investment. And for reporting, that Form 1099-K for third-party networks like payment apps or online marketplaces, the threshold goes way up. You only get a 1099-K if you earn more than $20,000 and have more than 200 separate transactions.
It reduces the paperwork burden for casual sellers or gig workers.
Significantly. Also, that 10% excise tax on indoor tanning services, repealed immediately.
Okay. There are also changes to the Low-Income Housing Tax Credit, LIHTC. That's crucial for affordable housing.
It is. The bill restores the 9% LIHTC allocation amount back to its 2021 level, plus a 12.5% increase for the years 2026 to 2029. It also makes it easier for projects financed with tax-exempt bonds to qualify for the 4% LIHTC. And importantly, Indian reservations and rural areas are now automatically designated as difficult development areas.
Which means they get extra support.
Yes, it effectively provides an enhanced credit in those areas, making it more financially viable to build affordable housing there. And finally, for businesses, the definition of a small manufacturing business gets expanded. The gross receipts threshold goes way up, from around $31 million now to roughly $100 million by 2026.
Allowing more manufacturers to qualify for small business tax benefits.
Correct.
And under this section, how does the bill specifically target the health of rural America?
It expands the definition of a rural emergency hospital, or REH, under Medicare. Crucially, it creates a look-back period. If a qualifying rural hospital closed sometime between January 2014 and December 2020, it can now potentially reopen under this new REH designation.
So a chance to bring back hospitals that closed in struggling rural areas.
Exactly. A direct measure aimed at restoring essential healthcare access in those communities.
Okay, now for some of the potentially most impactful shifts, touching on broader national priorities. This subtitle, Make America Win Again, seems to drive some really big changes. Energy policy, taxes on certain groups, and immigration and border security.
Yeah, this section definitely reflects a clear reprioritization of federal resources and policies. It hits everything from those green energy initiatives we saw ramp up previously to how universities operate, how we manage the border, and there are several measures aimed squarely at preventing fraud and abuse in government programs.
So, starting with the part labeled Working Families Over Elites, what's happening with existing clean energy credits? This sounds like a major reversal.
It is a significant shift away from the green energy incentives of the previous administration, yes. The bill accelerates the expiration date for a whole bunch of clean vehicle tax credits. Credits for used EVs, new EVs, commercial clean vehicles, even alternative fuel refueling property. They're all set to expire December 31st, 2025 now, much sooner than planned.
Wow. Okay, and home energy credits.
Same story. Credits for energy-efficient home improvements, residential clean energy like solar panels, and new energy-efficient homes also accelerated to expire at the end of 2025.
And the big ones for generating clean electricity.
Those face a steep phase-out. The production and investment tax credits will be reduced starting in 2029, down 20%, then 40%, then 60%. And after December 31st, 2031, zero credit available.
A dramatic curtailment.
It is. And the ability to transfer these credits, which was a big feature of the previous law, that's repealed for facilities where construction begins 2 years after this bill passes. Plus, access is restricted for what they call prohibited foreign entities.
So a major redirection of energy policy, away from subsidizing renewables as heavily. Are other clean energy credits affected? Oh, yes. Transferability is eliminated for the clean fuel production credit after 2027. There are new restrictions on the carbon capture tax credit, including repeal of transferability for new projects, the credit for zero-emission nuclear power, phased out on a similar schedule to the clean electricity credits, and its transferability is gone too. Hydrogen. The clean hydrogen production credit is terminated for facilities starting construction after the end of 2025. And the advanced manufacturing production credit that's modified and accelerated for termination too. When energy components lose their credit after 2027, everything else after 2031. Transferability repealed after 2027, restrictions on foreign entities, even based on licensing deals.
So across the board, a major rollback of those clean energy incentives.
That's the clear impact, yes.
Okay, beyond energy, what other groups or entities see tax changes here? Sports franchises. Yeah, if you acquire a pro sports franchise, you can now only amortize 50% of the intangible asset value, things like goodwill or player contracts. Applies to acquisitions after enactment.
And executive compensation.
New aggregation rules apply for figuring out excessive employee pay in publicly held companies. And the excise tax on excessive pay within tax-exempt organizations gets expanded significantly. A covered employee subject to the tax is now any employee getting over $1 million in pay, not just the top few.
That broadens its reach quite a bit.
Considerably.
And for college endowments and private foundations, they've been under scrutiny. What changes for them?
The excise tax on the investment income of wealthy private colleges and universities is modified. It becomes a tiered system based on the endowment value per student. So maybe 1.4% tax for endowments around $500K per student, but it could go up to 8% for the wealthiest schools with endowments over $2 million per student.
A sliding scale based on wealth per student.
Exactly. And a similar tiered system is applied to the tax on net investment income for private foundations based on their total assets. Ranges from 1.39% for smaller foundations up to 10% for those with $5 billion or more in assets.
So higher taxes on the largest endowments and foundations.
That's the policy. It also expands what counts as unrelated business taxable income, UBTI, for tax exempts. Includes things like amounts paid for disallowed fringe benefits, income from selling or licensing the org's name or logo, and income from non-public research if their purpose is public research.
Tightening the definition of tax-exempt activity.
Seems like it. Also, the limit on excess business losses for non-corporate taxpayers. Made permanent. And for firearm owners, that $200 transfer tax on firearm silencers is eliminated.
A specific tax repeal there. What about commercial shipments coming into the U.S.?
That $800 de minimis threshold, which let lots of small packages enter duty-free, it's repealed worldwide, effective July 1st, 2027.
Meaning more imports will face duties and inspection.
Correct. And penalties for trying to evade that are increased.
Okay, now let's turn to a section with really significant policy implications. Measures aimed at removing taxpayer benefits for illegal immigrants. What does the bill do about healthcare premium tax credits and Medicare eligibility?
It explicitly makes individuals described in the bill as illegal immigrants ineligible for the Affordable Care Act's premium tax credits. Eligibility is restricted mainly to lawful permanent residents, certain Cuban immigrants, and people under compacts of free association.
So it removes eligibility for those without legal status.
Yes. And it specifically makes people with statuses like asylum applicants, parolees, or TPS ineligible too. It also closes a loophole that allowed some non-citizens who weren't eligible for Medicaid due to their status to still get premium tax credits.
And Medicare.
Similar restrictions. Medicare eligibility is also eliminated for illegal immigrants, limited again to lawful permanent residents and those specific other statuses. These are direct measures to limit access to federal benefits based on immigration status.
And there's a new tax on sending money abroad? Remittances.
Yes, a new 1% excise tax on remittance transfers. The sender pays the tax, and the money transfer company collects it. There is an exception if the sender can verify they are a U.S. citizen or national.
And education credits.
The Social Security number requirement is added for both the student and the taxpayer clipping the American Opportunity Tax Credit or the Lifetime Learning Credit. Tightens eligibility there, too.
Okay. Finally, under this subtitle, what's being done to prevent fraud, waste, and abuse in government programs?
A few things. For those health plan premium tax credits, you can't claim them if your eligibility isn't actively verified every year. Credits are also disallowed if you enroll through one of those special enrollment periods triggered just by an income change. And the cap on how much advanced premium tax credit the government can claw back if you got too much,
Right.
that cap is eliminated. You have to repay the full excess amount.
So stricter verification and full repayment if overpaid.
Right.
Any use of technology to fight fraud, AI maybe.
Yes, actually. $25 million is given to the Secretary of Health and Human Services to hire AI experts. Their job is specifically to help reduce and recoup improper payments within the Medicare program, using AI to find fraud.
Interesting. And those COVID-era employee retention credits, ERTC, lots to talk about fraud there.
Big focus here. Penalties are increased for promoters who help businesses improperly claim the ERTC. Promoters also have to meet due diligence requirements now or face a $1,000 penalty per failure. And the IRS is basically barred from paying out any more unpaid ERTC claims unless the claim was filed way back by January 31st, 2024. Trying to shut the door on late, potentially fraudulent claims.
Wow, okay. What about the Earned Income Tax Credit, EITC? That's a major benefit for lower-income workers, but also prone to errors.
Right. The bill sets up a phased system to detect and manage duplicate EITC claims. Starts with notices, then refund holds, and eventually could lead to a pre-certification process where you have to prove eligibility before getting the credit.
Proactive prevention.
That's the idea. A task force will also look at using third-party data sources to improve accuracy. On a positive note, there's an extra EITC amount for Purple Heart recipients who lost disability benefits because they returned to work.
Okay. What's happening with the IRS's own free tax filing system?
The current IRS Direct File pilot program is terminated. It's being replaced by a mandate for a public-private partnership. The IRS has to work with private tax prep companies to offer free tax filing options. A different approach.
A shift to partnership instead of direct government service.
Exactly. Also, the IRS is directed to pause tax deadlines and penalties for individuals held hostage or wrongfully detained abroad. And the Treasury Secretary gets new authority to suspend the tax-exempt status of any organization found to be providing material support to listed terrorist groups.
A national security tool using tax status.
Yes. And finally, penalties for leaking taxpayer information dramatically increased. Maximum fine of $250,000 up to 10 years in prison, and each taxpayer affected counts as a separate violation. Stronger protection for privacy.
Okay. And underlying all these policy changes, there's the debt limit.
Right. You can't make all these changes without addressing the government's borrowing authority. This provision directly increases the statutory debt limit by $4 trillion.
$4 trillion. That allows the government to keep paying its bills and fund everything in this massive package.
Essentially, yes. It covers the projected borrowing needs stemming from these policies for a period of time.
So we've seen this bill isn't just about taxes. It really does touch almost every corner of federal policy. Let's try to zoom out a bit and hit some of the other major shifts. Healthcare programs, defense.
Absolutely. Connecting these dots helps show the truly comprehensive nature of this bill and how wide the ripple effects could be. Let's start with major healthcare programs again: Medicaid, CHIP, Medicare, ACA. For Medicaid and CHIP, the bill introduces community engagement requirements.
Like work requirements.
Essentially, yes. 80 hours a month of work, education, or similar activities for able-bodied adults aged 19 up, without dependents under 6. It also limits access for certain non-citizens, requires states to check against death records quarterly, and mandates eligibility redeterminations every 6 months.
More frequent checks.
Much more frequent. Tries to prevent dual enrollment, too. It also restricts federal funding going to what it calls prohibited entities, like certain nonprofits mainly involved in family planning or abortion services. And it sunsets that enhanced federal funding match, the FMAP incentive that encouraged states to expand Medicaid under the ACA.
So less incentive for any remaining states to expand.
Correct. States are also required to impose higher cost sharing on beneficiaries, up to $35 maximum for some services, and there are new caps on certain Medicaid payment programs, limiting them to Medicare rates.
Okay. What about Medicare and the Affordable Care Act, the ACA?
For Medicare, it again limits non-citizen access related to premium tax credits. It does include a temporary 2.5% bump in payments for doctors under the Medicare physician fee schedule for 2026. That's the doc fix.
Always seems to be one of those.
Pretty much. It also expands the exemption for orphan drugs for rare diseases from the Medicare Drug Price Negotiation Program. That's significant for pharma companies developing those drugs.
Right. And the ACA itself.
Again, limits premium tax credit availability on the marketplaces based on immigration status, requires monthly verification of eligibility for those credits. And crucially, this bill does not extend the enhanced premium tax credits from the American Rescue Plan. Those expire at the end of 2025.
Meaning premiums could go up significantly for people buying insurance on the ACA marketplaces.
That's the likely outcome for many, yes.
Is there anything positive for rural healthcare in this section?
Yes, a major initiative. A new rural health transformation program. $50 billion over 5 years. It's designed to support rural hospitals and providers. States have to submit detailed plans on how they'll use the funds to transform rural healthcare delivery.
$50 billion is a serious investment.
It's very significant. And one more thing. Enforcement of 3 big regulations from the previous administration dealing with Medicaid eligibility, streamlining, and minimum staffing in nursing homes is delayed, pushed way out to September 2034.
A long delay.
Yeah.
Gives states and providers a lot more time.
A huge amount of breathing room, yes.
Okay, let's shift to energy policy and environmental regulations. What's mandated for oil and gas leasing? Sounds like a push for more domestic production.
Definitely. It mandates quarterly onshore oil and gas lease sales in 9 western states for the next 10 years. At least half the nominated parcels must be offered. Offshore, it requires at least 2 lease sales a year in the Gulf of Mexico for 15 years, and at least 6 in Alaska's Cook Inlet area.
And royalty rates.
The onshore royalty rate is restored back down to 12.5%, and that methane emissions fee from the Inflation Reduction Act repealed. For coal mining, it restores leasing activities and reduces the royalty rate from 12.5% down to 7%.
So clear moves to boost fossil fuel production and lower costs for producers.
That's the direction.
What about public lands and environmental funding?
The bill mandates increased timber sales from the Forest Service and Bureau of Land Management. It adjusts rents and fees for wind and solar projects on public lands, aiming for more revenue, and sets up revenue sharing with states and counties. It also rescinds funds from the Inflation Reduction Act that were meant for national parks and public lands improvements.
Taking back money allocated for parks.
Yes. Money is appropriated for the Strategic Petroleum Reserve for maintenance and buying more oil. And perhaps most strikingly, unobligated funds from numerous clean energy and vehicle programs created by the IRA across DOE, EPA, the White House are repealed or rescinded. Billions in savings claimed by pulling back that unspent money.
So money allocated for green initiatives, if not yet spent, is gone.
Largely, yes. The DOE loan program is also amended. Instead of focusing on clean energy, it's redirected to fund traditional energy projects and critical minerals, with $1 billion appropriated for that.
A fundamental shift in the loan program's purpose.
Absolutely. And reflecting a different priority, $150 million is appropriated for DOE national labs to partner with industry on curating data for AI and developing self-improving AI specifically for energy applications.
AI and energy? Interesting. Let's turn to national security. This bill includes a truly massive funding increase for defense.
It's historic. Over $150 billion in additional funding pushes the total DoD budget for fiscal year 2026 over $1 trillion for the first time ever.
Over $1 trillion. Where's that money going?
Across the board, really, focusing on strategic capabilities. A big chunk, $9 billion, is for quality of life for military personnel. Things like housing, healthcare, education, family support. Includes almost $3 billion just for housing allowances and $2 billion for the Defense Health Program.
A significant investment in the troops and their families.
A very visible commitment, yes.
What about hardware? Shipbuilding is always critical.
Huge investment there. $29 billion for shipbuilding. Funds 2 guided missile destroyers, a second Virginia-class attack submarine, development of unmanned naval vessels, plus money to strengthen the shipyards themselves. A major push to grow the fleet.
And missile defense.
$25 billion for integrated air and missile defense. Includes money for advanced space-based sensors and interceptors, part of that Golden Dome for America concept, a layered defense shield.
Munitions and supply chains have been a concern lately, too.
Addressed here, $25 billion for munitions and shoring up the defense supply chain. Includes $5 billion specifically for critical mineral supply chains, $3.3 billion to expand domestic defense manufacturing, and $1 billion for next-gen automated munitions factories.
Trying to build more resilient domestic production.
Exactly. There's also $16 billion for scaling up production of low-cost, innovative weapons, sometimes called attritable platforms,
Yeah.
getting new tech out faster, and $380 million for improving efficiency in cybersecurity, using automation and AI to speed up DoD financial audits and protect networks.
What about air power and nuclear forces? Core defense pillars.
Air superiority gets $9 billion, funds more F-15EX fighters, accelerates the next-generation fighter programs, FAX and collaborative combat aircraft, and invests in long-range strike. Nuclear forces receive $15 billion to continue modernizing the triad. Significant funding for B-21 Raider bomber production, the Sentinel ICBM replacement, and developing that nuclear sea-launched cruise missile.
A clear focus on high-end capabilities.
Very much so.
And the Indo-Pacific region, a major strategic focus.
$12 billion specifically for Indo-Pacific command capabilities. Strengthening U.S. posture there includes money for military satellites, infrastructure, offensive cyber ops. Improving overall readiness gets $16 billion tackling maintenance backlogs, facility upgrades across all services. Big chunks for Air Force facilities and Navy shipyards.
Yeah, and border support.
$1 billion specifically for DoD support to border security operations. Plus, funds for oversight by the DoD Inspector General and for various military construction projects. It's a very comprehensive defense package.
Okay. The bill also hits education funding and policy pretty hard. Student loans seem to be a major target.
Yes, significant changes there. It ends the existing income contingent repayment plans, ICR, for new borrowers, starting July 1st, 2026. They're replaced by a new plan called the Repayment Assistance Plan, or RAP.
RAP, how does that work?
It's still income-based, apparently with a $10 per month minimum payment. And importantly, payments under RAP do count towards Public Service Loan Forgiveness, PSLF.
Okay, a new system. What about loans for grad school?
Big change here. The Federal Direct Graduate PLUS Loan Program is terminated for graduate and professional students starting July 1st, 2026.
Wow, that's a major source of funding for grad students gone.
It is. Annual and lifetime borrowing limits for other graduate, professional, and parent loans are also adjusted.
What about pausing payments? Deferment? Forbearance.
Those are being curtailed.
Yeah.
Unemployment and economic hardship deferments for direct loans end after July 1st, 2027. And forbearance is capped maximum of 9 months total over a 2-year period. A push to get people into repayment faster.
Okay. And eligibility for student aid itself.
Some family-owned assets farms, small businesses under 100 employees, are now excluded from the federal student aid need analysis calculation.
Could help more families from those backgrounds qualify for aid.
Potentially, yes. Pell Grant eligibility is also tweaked based on foreign income and other non-federal grants received. But a key new initiative is expanding Pell Grants to students in short-term workforce programs, starting July 1st, 2026.
So, Pell Grants for job training, not just traditional degrees.
Exactly, as long as the program leads to a recognized credential and meets industry hiring needs, a direct link to workforce development.
And more accountability for schools.
Yes. Institutions can't award federal student aid anymore for programs deemed to have low earning outcomes.
Right.
And they have to warn students if a program isn't meeting those earnings requirements. Puts pressure on schools to deliver value.
Okay. And loan discharge rules.
The bill further delays implementation of those Biden-era rules for borrower defense to repayment and close school discharge. It actually restores the 2020 regulations instead. Changes how relief is handled in those situations.
All right. Moving to agriculture and rural development. What's happening with nutrition programs, like SNAP, food stamps?
Significant changes here, too, generally aimed at tightening eligibility and reducing costs. Future updates to the Thrifty Food Plan, which sets benefit levels, must be cost-neutral based on inflation, could limit future increases. SNAP eligibility is revised. Work requirements are expanded to cover ages 55 through 65, and also parents whose youngest child is over 14. And the USDA loses its authority to waive these requirements.
Stricter work rules for more people?
Yes. The standard utility allowance, which helps with utility costs, is limited just to elderly or disabled households now. State cash assistance now counts as income, reducing benefits for some. The SNTAP aid nutrition education program is eliminated entirely, and undocumented immigrants are explicitly barred from receiving SNAP benefits.
Wow. A lot of changes tightening SNP.
Definitely. And states face higher cost sharing if their payment error rates are high. Federal share for administering SNAP is also reduced.
Okay. What about forestry and farm commodity programs?
Unspent IRA funds for old-growth forests and urban tree planting are rescinded, a shift away from those initiatives. For farm commodities, Reference prices for all covered commodities are increased. That provides a higher safety net price for farmers.
Good news for farmers there.
Yes. Base acre coverage is extended. 30 million new base acres are added. The main farm income support programs, PLC and ARC, are extended through 2031. And the limit on how much Title I support payments one entity can receive is increased to $155,000. So significant support for traditional commodity agriculture.
What about help for farmers facing disasters or needing crop insurance?
Access to disaster assistance and conservation programs is expanded. Reimbursement rates for disaster losses are increased. Support for beginning farmers and ranchers is extended. Crop insurance coverage levels are increased, and the federal premium support is boosted, making insurance more affordable.
Strengthening the safety net.
Yes. And there's a new pilot program specifically for insuring contract poultry growers, addresses the gap. There's also additional mandatory funding for conservation programs, repurposing some IRA money, more funding for agricultural trade promotion, food banks, research, biofuels, horticulture, a broad investment across the agricultural sector.
Okay. Let's turn to transportation and infrastructure. What new spending is in the bill? Air traffic control.
Yes, a major down payment. $12.5 billion towards a larger $31 billion plan to modernize the nation's air traffic control system. Big focus on safety and efficiency.
Coast Guard.
$24.6 billion for Coast Guard readiness. Includes money for new cutters, aircraft, shoring up their operational capabilities.
And NASA gets a boost.
$10 billion for NASA priorities. Includes funding for a Mars telecommunications orbiter, the Artemis Lunar Gateway orbiting the Moon, the Space Launch System rocket, the Orion crew capsule, and continued support for the International Space Station.
Keeping space exploration funded.
Yes. And an interesting detail. The bill directs NASA to move the retired Space Shuttle Discovery orbiter from its current museum in Virginia to the Johnson Space Center in Houston for display.
Okay. And how is the bill paying for some of this? Revenue raisers.
A few ways. Again, it rescinds unspent funds from various IRA programs, this time within the FAA, Federal Highway Administration, EPA, and NOAA. Redirecting that money. It restores the FCC's authority to auction off spectrum licenses. That's expected to raise a lot of money, over $85 billion potentially.
A huge revenue source.
Massive. It also requires the Department of Transportation to renegotiate the leases for the two major airports near D.C. Dulles and Reagan National to charge market rates. The Brand USA Travel Promotion Fund is cut way back, from $100 million down to $20 million, and unspent money from a fund for wireless supply chain innovation is rescinded.
Were there any transportation items discussed earlier that didn't make the final cut?
Yes, good point. Notably, a proposed $500 million specifically for AI infrastructure spending was not included in the final bill, and a proposed annual fee on electric and hybrid vehicles also didn't make it in.
Interesting exclusions. Okay, finally, let's circle back to immigration and border security. Beyond the tax changes we already discussed, what else is in there?
The bill imposes several new or increased fees on immigrants. A $100 fee for asylum applications, $1,000 for parole requests, $500 for temporary protected status, TPS applications, and another $550 for work permits for TPS recipients.
Increases the cost significantly for applicants.
It does. And then there's enforcement funding. Billions appropriated to DHS, ICE, and the Department of Justice, the big numbers. $45 billion intended to expand U.S. immigration detention capacity. $29 billion for increased ICE activities enforcement, removal ops, and $3.3 billion for DOJ to hire more immigration judges and support staff to process cases faster.
Huge sums for enforcement and detention.
Massive increases. The bill also provides $10 billion to reimburse state and local governments for costs they've incurred on border security efforts since January 2021, and another $3.5 billion in grants for state and local immigration enforcement activities, including specific money set aside through Homeland Security grants for security related to the 2026 FIFA World Cup and the 2028 Los Angeles Olympics.
So, significant federal funding flowing to states and localities for border and immigration enforcement.
That's a major component, yes.
What?
Bolstering border security and enforcement capabilities at all levels.
Wow, what a journey. We've just walked through the one big, beautiful bill, and it really is a legislative leviathan. It touches, practically every facet of American life. Your taxes, your healthcare, energy, defense, education, even space exploration. The sheer scale, the complexity, the number of shifts. It's just astounding.
It really is. And this raises, I think, an important question as you, the listener, absorb all these changes. What stands out to you? What do you see as the most impactful provision, maybe for yourself personally, or for your community, or even the nation as a whole? You have to consider how all these interconnected policies, especially the dramatic shifts we saw in energy, immigration, taxes, healthcare access, how they'll genuinely reshape the landscape
Yeah.
for individuals, for businesses, for the government itself in the coming years.
Yeah.
The long-term ripple effects of a bill this comprehensive
Yeah.
on the economy, the environment, our social fabric, it's going to be something to watch very, very closely.
That is definitely a provocative thought to end on. And we really hope this deep dive has, given you a bit of a shortcut to getting informed. Maybe spark your curiosity to dig even deeper into the parts that matter most to you.
Yeah.
Until next time, keep digging, keep learning, and stay informed.